My favorite tax credit out there, the retirement savers credit. Apparently 50% of the people don't even know it exists. I'm going to make sure you do and know the details of that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so we do a ton of tax preparation here at Korhorn Financial Group, but tax planning is really where it's at. Your overall financial life has 6 different areas to it that you need to be planning for and how those areas interact, because they do. They interact together. Tax planning is one of them, and planning is all about taking a look and surveying all of the strategies available to you to have you pay less tax. Pay less tax ideally over your lifetime or even multiple generations, but certainly accounting for how can you pay less tax each and every year. And so tax planning is the creative part. It's the way for you to make sure that when you show up and get your tax return prepared, that you actually like the result and you've captured all the opportunities. Well, been doing this for 20 years. We do around 4,000 tax returns a year, so tons of experience between myself, but really our collective team here at Korhorn Financial Group. And of all the tax deductions, of all the tax credits, here's my favorite, okay? My favorite is the Retirement Savers Contribution Credit. We sometimes just call it the Retirement Savers Credit. Why is it my favorite? Because number one, it's a credit. Deductions are good, okay? Deductions reduce your income and then taxes applied on that smaller amount. But a credit is great. A credit is a dollar for dollar reduction in the amount of tax that's due. So number one, this is the Retirement Savers Credit. So already it's better than a deduction, so I like that. But second, it's a credit for you doing what you should be doing anyway for your financial future, and that's saving into retirement accounts, and you get a tax credit for doing that. Wonderful. Now, it doesn't apply to everyone, but certainly you should know about it and take advantage of it if it does apply to you. That's why this headline caught me off guard. Maybe it's clickbait, I don't know, but 50% of workers don't even know what this credit is. That is hard to fathom. So let's make some comments. Let's push this video around. Make sure more and more people know this, because this is free money. It's not really free. It's other taxpayer dollars. But listen, this is in the tax code, where if you're saving into, if you are eligible, we'll go through that in just a second, and you're saving into the right retirement accounts, you should be getting this tax credit. And I fear way too many people, because they don't know about it, they're not getting it even when they should. All right, so let's get into what the Retirement Savers Credit is. Let's start with who's eligible. Okay, you got to be 18 or older. You have to not be claimed as a dependent on someone else's return. So you not only need to file your own return, but no one else can claim you, okay? And you need to not be a student. Now, that gets a little tricky during the year that you maybe graduate or leave school, until there's details in there about whether you've been in school for 5 months or whatever else. But you can't be a full-time student, and you can't really be a dependent on someone else's return. Otherwise, and you're 18, otherwise fair game, okay? So here's how the Retirement Savers Credit works. If your adjusted gross income is below a certain level, okay, we'll get into that in just a second, then you are eligible for a tax credit based on the amount of contributions that you make to a retirement plan. And that retirement plan could be your simple IRA, could be your 401k, could be your 403b, but it also could be your IRA or your Roth IRA, okay? So the contribution needs to be into a retirement plan, okay? And then you get a tax credit based on the amount of your adjusted gross income on the first $2,000 that you contribute. So let's take a look first at what that credit is and what those limits, those adjusted gross income limits, are for 2021, okay, since that's the tax year that most people are filing for right now. If your income, married, filing jointly, if your adjusted gross income is below $66,000, then, if it's above $66,000, you don't get any tax credit. But if it's between $43,000 and $66,000, then you get a 10% credit on the first $2,000 that you contribute to your retirement account. So it's a $200 tax credit. And again, that's not a deduction. That's dollar for dollar back in your pocket for contributing $2,000 to a retirement account. If your adjusted gross income is between $43,000 and $39,501, that's a 20% tax credit. So that'd be $400. And then get this, if your adjusted gross income, again, married, filing jointly, so going to be more difficult because there's two of you, is below $39,500, 50% tax credit. That's $1,000 back in your pocket, okay? You can see here also on this table, the limit applies for head of household or all other filers, so that would be individual filing single return. So that's the tax credit. That's who's eligible for the tax credit, again, on the first two grand that you contribute. Also take a look then at 2022, depending on when you're consuming this. Obviously, this credit, these income amounts change a little bit each and every year. You can see for 2022, you're totally phased out, married filing jointly if your income's above $68,000. And so make sure each year that you're aware of what these thresholds are so that you can plan. So let's hit that. How can you plan? What are the tricks in order to make sure you qualify? Well, the very first one, make sure you do the full $2,000 of contributions. So many times as I'm reviewing or delivering a return for someone that we serve, they've contributed maybe $1,500, or they weren't aware of this, and so they're getting some retirement savers tax credit. I can see it on their return, but it's not the full amount because they haven't contributed the full $2,000. So make sure that you're doing that. If you've only contributed $1,500 and you look and you say, well, I'm getting part of this this credit, I've got a big tax refund. Say, all right, I'm going to do the rest of, I'm going to put the remaining $500 in before April 15 so that I can increase my tax credit. You can update that on your return. Say, yep, I solemnly swear I will make this contribution for last year before the tax filing deadline, and then bam, you get the bigger tax credit right there. It boosts your refund. That's the first trick. Second trick, if you're married and filing jointly and your income limits are below this threshold, what we see often is it's a one-income household. And with a one-income household, usually that means just one person is contributing to retirement. I told you the tax credit's on the first $2,000 that you contribute per spouse. So you might be contributing 10% of your income to the 401k, so you've surpassed that $2,000 that qualifies for this credit. But you could do another $2,000 into a Roth IRA for your spouse, and then that would make that $2,000 also eligible for the tax credit as well. So in a married filing jointly, it's $2,000 each, so for a total of $4,000 that you could get this tax credit on. The third, if your adjusted gross income is close to the $66,000 threshold or even close to one of the other thresholds, you can make pre-tax contributions, IRA, HSA, if you qualify, if you're eligible, to bring your adjusted gross income below that level to make you qualify. You'd think that, oh, well, the IRS is probably so mean that if I don't normally qualify, when I make my retirement contribution, now that brings my income below, they're not going to give me that credit because my income would have been too high without this. No. You can make a pre-tax contribution to get your adjusted gross income below that threshold, and then they still give you the tax credit. So take advantage of that. And then finally, for those of you that are doing that, consider doing pre-tax contributions to get you right below that threshold, and then do Roth contributions for the remaining amount of your $2,000. Why? Because if you're in these tax limits where this credit applies, you're in a low tax bracket. And so should you really be contributing pre-tax, or would it make sense to contribute Roth, have those dollars grow tax-free forever? Depends on your situation, okay? But for many people, we're looking at, all right, just do enough pre-tax so that you get below that threshold, and then do the rest Roth so that you're maximizing your retirement savers credit and taking advantage of those Roth dollars being able to grow tax-free forever. I love the retirement savers credit. I can't believe half of employees out there don't even know this thing exists. Now you do. If you have questions, work with your CFP. Lots of planning that can go involved here, but this is, yes, it's not free money, but it'd be free to you. It'd be free to you. Make sure that you're getting all the tax credit that you possibly can. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.